How are you today, Chad?
Good, Emily. Can you hear me okay?
I can hear you. Can you hear me okay?
Yeah, well, no, sounds like we're in good shape.
Yep. Can you see the screen, the Symfona slide?
Yeah.
Okay. All right. So I think we've hit enough now that we can probably kick it off. It's just starting. We're going to kick off, start with a few housekeeping items anyway. No big misses there. Thank you for joining us today for Symphona's 2023 year-end tax update. We'll be touching on some future year items as well as we go through the presentation. But let's just go through a couple of administrative items before we begin. I do seem to have a little bit of a lag, so if I click and nothing happens, it's just my computer thinking really hard about switching slides. Um, our webinar will be recorded today, so if that's something that um, hopefully we'll be able to share it later within 48 hours, and we'll also be sending a copy of our slides. If you have any technical difficulties, Mackenzie's already shared in the chat. Please reach out to her. And then also, if you have questions throughout the presentation, please use the Q&A button at the bottom of the Zoom line. That way we can get back to you as soon as possible and also get through. We're trying to respect everyone's time and get through the presentation in the allotted hour today. And we originally were going to have another presenter. They had a conflict come up, so Chad has graciously stepped in to offer his expertise today. And with that, I'll turn it over to him.
Make sure I'm on the. Yeah, just as a disclaimer, income tax planning is due to your individual situation. We're giving you some general overall information here just to make you aware of things, maybe jog your memory, maybe give you an opportunity to reach out to us if you think something might apply to you that we can help you with and further explain or figure out your situation. Yeah, I guess that's basically what the slide says. Income taxes aren't the only thing to consider when you make moves. You don't want to lose money for tax purposes. You don't want to lose more money that you have than you have to pay in taxes. So this isn't the only consideration. Obviously, there's a lot of other possibilities.
Yep. All right. Today's webinar will be going over really just these broad categories, mostly tax updates, broad planning ideas for individuals and businesses. We want to touch on some of the upcoming expiring provisions at the end of tax year 2025 that you may want to begin thinking about, and then also walking through several new credits, both on the individual and business side. Chad's going to walk us through some of the high level stuff, though, for individuals first.
This is the 2023 federal tax brackets. Since 2018, these have been adjusted for inflation. So these go up a little every year for purposes of you not getting additional wages with inflation and then putting yourself in a more difficult tax bracket. We do expect these to go up by 5.4% for 2024. So the brackets will go up again. Obviously, the less money you make, the lower the tax rate you make. Something to consider here, if you did not have a change in income from 2022 to 2023, with the tax brackets going up, your tax what you will owe drops a little bit. So if your income stays the same, in theory, your income tax should drop a little bit.
Yeah, that's always good news. All right.
So capital gains, this is kind of a fun one. So the idea with capital gain harvesting, basically, if you've made a lot of money with capital gains during the year, one of the opportunities is loss harvesting. It's basically if you've already sold something and you've got a big capital gain and you've got a stock that you know is a loser, you don't think it's ever going to go up, you can offset some of your gain that way. Also, with big events, it makes sense frequently to plan around that. The idea is income smoothing, so you don't put yourself in a higher tax bracket with your big capital gain events. If you look down to the bracket down here below, so obviously capital gains, generally speaking, are 15% if they're long term. We want to keep that out of the 20%. So that's an opportunity we have with tax planning there. Probably the most fun part of this is the 0%. So I deal with financial planners on a regular basis to see what opportunities are available to clients. There are specific clients where you can make $90,000 in capital gains and pay zero tax on it. I've got several of those we do here. Obviously, that's very limited circumstances where you've got somebody with fixed income or no RMDs that's retired. They can kind of control their income. They can manage their capital gains to sell it in a year, in which case they would owe. Again, that's a very limited opportunity, but it is available to some people and it is worth exploring.
Okay.
Maximizing deductions. So this, generally speaking, has to do with your itemized deductions. So the way this works is since 2018, we've had this enhanced standard deduction. Now, most people take the standard deduction because they can't get their deductions high enough for that, and that's a good thing because if you've got a higher standard deduction, you're getting benefit for expenses that you did not incur. So for 2023, the standard deduction is $27,700. What that means is, generally speaking, your state income taxes plus your mortgage interest plus your charitable contributions all have to be in excess of $27,700 before you can itemize, at which point each available dollar benefits you for tax purposes. The state income taxes plus real estate taxes that makes up the income or the tax component of that is limited to $10,000 currently. So for most people, they can't get here. The opportunity, there's a few strategies we have here. One, the higher you make this number, the less income taxes you pay. There's also state benefits. So the state benefit for the standard deduction for Georgia runs around $5,500, I believe. So if you take the standard deduction for federal, you're only allowed the $5,500 for Georgia. So if you can itemize, it makes sense, especially from a state income tax perspective for the state of Georgia. I know we have other states, but it works similarly with them, the states right around here at least. This is set to sunset back to around half the deduction for 2025, after 2025. Something we do a lot, and we talk to clients about this a lot, is the bunching strategy. Basically, if you can control your charitable contributions over the course of, say, 2 years, it makes sense to bunch them all into 1 year, which allows a few opportunities. One, it allows you to get a benefit for all of your altruistic endeavors, gets you over the standard deduction for 1 year, and the other year you just get the free $27,700 that everybody gets. So that is something we generally like to work with there.
All right. Thank you, Chad. Yep. Thank you, Chad. I'm going to be expanding on some more deduction opportunities. We're going to look at retirement and see what we can do to minimize what's actually taxable to us. Many people participate in 401k plans for 2024. You want to review what you're contributing. The limitation goes up by $500. And also you want to make sure that you have given as much as you'd like to by the end of this year, 12/31. There's not an opportunity to give to your 401k after the close of the calendar year. The other 3 plans listed here, though, are all individual retirement accounts or IRAs. Those contributions can be made up until the earlier of April 15th or the filing of your tax return. If you have higher income, however, or for the thinking about the traditional and Roth IRA contribution limits, you won't be able to take advantage of those if you're above a certain, and when I say that, you won't be able to receive a deduction for your contributions if you're above certain threshold limits. But there is a planning opportunity. You are able to give to a traditional IRA with after-tax dollars. And then what you can do is then convert that traditional IRA to a Roth. And those withdrawals later will come out tax-free. That is called a backdoor Roth IRA or backdoor Roth opportunity. IRS is looking to close that. So I highly recommend that if you are in need of making retirement contributions, that you pursue this opportunity in the next couple of years, because I do believe it will be getting addressed and closed.
Emily, it also grows tax free, so that's also a very big benefit.
Exactly. Right. So if you're contributing, for example, for 23 and 24, that 6,500 and that 7,000, those contributions grow tax free over um, the duration of as you hold on to it. Obviously, if you're a small business owner, simple IRAs and SEP IRAs are great opportunities. Those contributions are much greater than the traditional and Roth. Um, and then I think that's all we have here. Going to continue on the retirement topic with the Secure Act 2.0. If you're not familiar with this legislation passed in late 2022. It is a provision designed really to encourage employers and employees to participate in retirement plans. There's some really great provisions that they've instituted, including automatic enrollment for all employees in 401k plans. Right now you have to opt into the 401k. You'll actually have to opt out of that going forward after, I believe, 2024. If you have student loan payments or you have employees with student loan payments and they don't have the cash to contribute to a retirement account, the employer can actually contribute the equivalent of that student loan payment to the retirement account on behalf of the employee. That's a new provision. There's some documentation required around that. And then employees can also opt to have their employer portion of their matching treated as a Roth contribution. And that Roth tends to be very beneficial for younger savers. So, and then emergency withdrawals are going to be available of up to $1,000. That's not been available before. And with everything going electronic, if you're receiving statements in your email, they may get lost, they may go to spam. So one of the Secure Act provisions is also to require one paper statement per year, just to make sure everybody knows what they're saved, what they have available. And the required minimum distribution age is also increasing again. It was recently increased from 70 and a half to 72, but now it's going up to 73. And there's going to be, I'll talk some more later about some planning opportunities there as well. Chad's going to take it back over though and talk about some of individual provisions that we need to be thinking about in the coming years.
Going back to the Secure Act, that slide
Sure.
that Emily just had up, that's really probably, this is all new. This is, most people aren't aware of any of this. So it's something to keep in consideration. These are high points that, again, I don't think most people are aware of this. Emily, we can go to the next slide if you want to.
Okay, sure.
Okay, so just kind of going over a general timeline of tax legislation. In 2017, the Tax Cuts and Jobs Act was passed, which went into effect in 2018. We're still in that. If no other legislation is passed, all of that will sunset at the end of 2025. So that means that the general rules here we're providing don't change until 2026, which will affect your taxes that you file in 2027. I hope I'm not getting too off the board here with the dates. So we're going to kind of go over some of this. We're coming up on 2025, so it's time to kind of look at what the law used to be and will, in theory, be in 2026 versus what it is now, just to get it in the back of your head and kind of hopefully provide some opportunities to take advantage of one side or the other with your taxable events. The biggest ticker items here is the estate tax and gift exemption reduction. So generally speaking, this took a lot of estate planning away from a lot of people, which is a very good thing because it made such a big exemption. So that went from, plus or minus inflation, $26 million. In 2026, that goes down in half. So again, we don't know the exact number, but adjusted for inflation, it's approximately half of that. So if your net worth is, somewhere around there, that is something to start considering. The standard deduction I mentioned earlier of $27,700, that's going to be approximately cut in half. So that allows more people to itemize. It's a good thing, but most people are taking the standard deduction. So it does take that additional deduction away from, the average taxpayer. The state and local income tax cap. So that is basically, when I mentioned earlier, the three components to itemized deduction, you have the taxes plus mortgage interest plus charitable contributions. Well, the tax component of that is your real estate taxes plus your income state taxes, local taxes too. Your car tags, all that is included in that. So that currently is capped at $10,000. So no matter what your income taxes are, everybody gets a deduction for $10,000 if that component is over $10,000. That goes away in 2026. So if you pay a lot of state income taxes, that's something to consider. It also the timing of when you pay real estate taxes may change that year too. Just thinking of opportunities off the top of my head here. On a smaller scale for a lot of people, a big scale for others, the child tax credit is currently at $2,000 per child. That's going to go down to $1,000 per child. Charitable contributions, this is a little more nuanced, but basically currently if you have $100,000 in income, you can deduct $60,000 in charitable contributions. With some fixed income people that are, comfortable and they don't have that much in the way of expenses, they want to make large charitable contributions. That's something to consider. In 2026, that goes to 50%. So that's only 10%. That's not going to affect most people. So the 2% itemized deductions, that's more of an accountant thing. I like it when the itemized deductions add up and then that goes on the tax return. This is like a 2% floor that comes back for higher income taxpayers. It just makes things a little more difficult for us, and it takes away a little bit of your deductions. That's not a big item. And the income tax brackets change again. So in 2017, the top income tax bracket just for income tax is 39.6%. That's coming back. It's currently at 37%. But kind of going down the scale of the entire income tax bracket rates, generally speaking, taxes are going to go up about 2% for each one. You go to the next slide. Yeah, thank you, Emily. This kind of breaks it down a little bit. The old tax law, well, the current tax law versus the old tax law, which comes back into effect in 2026. Again, your state and local taxes, which includes your real estate taxes, is limited to $10,000 currently. That's unlimited going forward. Mortgage interest, this is a good point here too. So if you purchase a house for $750,000 currently, you can deduct all of the interest. If it's more than that, we prorate what you're able to deduct, and you're not able to deduct all of your interest. In 2026, that goes back to the old law, which is $1 million house. So I guess if you're going to make a big real estate purchase for your home, you may want to wait until 2026. We kind of went over the charitable deduction limitations there. The job and expense miscellaneous deductions, that really, there's basically if you had employee related expenses as a W-2 employee, some of that comes back. A bigger deal is the moving expenses. Basically, you can't take moving expenses right now if you're not in the Army or the military. Under the prior law, you did get some benefit for that. So if you move for a business purpose outside of, I believe it's 50 miles, then you were able to deduct your moving expenses on your personal income taxes. Casualty losses, there's more beneficial stuff that comes back there in 2026 that hopefully doesn't affect anybody on this call.
Yep. Thank you, Chad. That's a really good overview.
You may want to skip this next slide. I think it's a duplicate, Emily.
It is. It is. I'm going to take it over from here and talk about the estate and gift that Chad's touched on already. Just reiterate the planning opportunity here in the short run is that limitation will be dropping soon. So if you have an estate that is going to be subject to this limitation, you want to be sure that you'll be able to take advantage of it before it reduces to half and beginning January 1 of 2026. There are going to continue to be small chances though. Just wanting to look at how inflation impacts this. If you look at 23, it was at 12,920,000, jumps up to 13,610,000. So for example, you used the gift limit in 2023, you are able to take advantage of the little bit of inflation growth for 2024. As a general rule, there's a base limit that you don't need to file a gift tax return for. That's $17,000 per person. If you're married, you can double that. And that's really another, that's also going up a little bit for 2024, but it's another way to help gift maybe to grandkids, and other family members or friends if you have that opportunity
Emily, on
available to you.
this,
Yeah, sure.
on your chart there, the gift and estate tax exemption, that's for a single individual, correct?
That is for, yes, that's
So if
correct.
you're married, it doubles. The
Correct.
gift tax exclusion, there can be some nuances there too with, you can give 34,000, but it really needs to be, from each member of the couple that's donating that.
Hmm.
If you're donating, if you're gifting money to family members or whomever, and it's around this amount, do get with us on this. We can help you make sure that you don't have to file a gift tax return, which doesn't cost money really for you in the form of taxes, but it's an administrative hassle, and it stays off of your long term filings with your estate taxes.
Right. Thank you, Chad. Other opportunities around individual planning include the energy credits. There's been a lot of press about this and efforts to give taxpayers incentives to make energy efficient improvements to their homes. If you have qualified property, you can receive a credit, and there are different categories. One, the maximum annual credit is $1,200, and in the other category, it's $2,000. And this is for your primary home. So if you have rental properties, this wouldn't, be applicable to those. Residential clean energy credits on the most popular item is solar panels. Those are not cheap, but you can get a credit of up to 30% on the cost of the solar panels. So thinking of a situation where you have a $40,000 solar panel installment to your home, that's a $12,000 tax credit on your return for the year that's installed. So it's a pretty significant credit. There's not a lot of credit opportunities in the world, and there's also no income limitation on these credits, which is also something that's not common. Clean vehicle credit, this was around in the past couple of years as well. It hasn't changed too much, except they've added some limitations. It's still $7,500, though it also now has an adjusted gross income limitation to it. It has not had in the past. So if you think you might qualify, make sure that you're inside the income limitations to be able to claim that credit. Moving on to education, again, not new, but things to be aware of are the American Opportunity Tax Credit and the Lifetime Learning Credit. Both have limitations on the number of years those can be claimed. That is based on the student, not the taxpayer. So for example, if you have the Lifetime Learning Credit, that's been claimed for your child for 4 years, and your child's continuing their education, they then cannot file independently and take it for an additional 4 years, because there's a 4-year limitation on that, claiming that credit. Other opportunities, though, the 529 plan, most people are aware of this, but there's some new nuances to it. 529 plans, you might be nervous if your child receives a credit, or maybe somebody went to, that college just didn't cost as much as what you saved for. They now are going to be allowing, starting in 2024, up to $35,000 of the 529 plan can be contributed to a Roth IRA. So that money is not going to be lost or penalized if it's withdrawn for non-qualified expenses. If you have a child and you think you might want to save, and you're saving in the state of Georgia, you definitely want to participate in the Georgia 529 plan, because under that plan, you're able to receive an $8,000 deduction per child. If it's not the Georgia 529 plan, unfortunately, you cannot claim that deduction in Georgia. It specifically needs to be the Georgia 529 plan. If you might be paying for private tuition or any kind of tuition expense for your primary schools or pre-college education, you can use up to $10,000 per year of the 529 plan to cover those expenses as well. For charitable, yep, go ahead.
Could you go back to that real quick, briefly?
Sure.
So something I do when I'm consulting with newer parents, when I had children, my parents basically gave them a small fortune worth of toys in the first year. I always try and encourage grandparents so grandparents get this for giving this to their grandkids too. I always encourage them to try and coach them into giving them less in the way of toys, which will expire in a year, and give them a 529 plan donation to the grandkids. This $8,000 limit is per student. So if you've got a bunch of grandkids or a bunch of nieces and nephews, you can give it all to them too, and it's a Georgia deduction for you, which isn't as beneficial as a federal, but it does grow tax free until come the time when they actually need to use it. I was just going to throw that out there.
Yeah, no, that's a great point. Thank you. So going back to charitable contributions, we've touched on this a little bit before when Chad went over batching your expenses. But another opportunity is for those taxpayers that might be 70 and a half. You're either receiving RMDs or you just want to give charitably from your IRA. Then you can take, if you are giving directly from the IRA to the qualified charitable organization, that income does not need to be included on your tax return. One caution here, though, if you have done that, it is not reflected on the 1099-R form. It will just show as a taxable distribution. Your CPA needs to know, that we need to know not only that it was a charitable gift, but we also need to know that it was specifically written from your IRA account. So that's been an opportunity for some clients. Non-cash contributions, just like in the past, we still need documentation for the donee organization, the address, the value of the property. And if you are possibly giving assets more than $5,000, just need a qualified appraisal for those. And something not as popular, but I have seen this, a couple people take advantage of this, are donor advised funds. These funds are, you can give directly to them, and then that fund will give to the nonprofit. It becomes deductible when it's a deduction when money's contributed to the fund, not when it goes to the nonprofit. So you may have, some reason to delay the contribution to the charity, or you don't know exactly where you want to give yet. You can give it to this fund, and then it will go to the charity at a later time.
It also grows while it's with the donor advised fund. And I'm thinking that the most likely circumstances, let's say you're a member of a church, and you think they're dependent on your charitable contribution on a monthly basis for their ongoing efforts, and you're concerned if you give them $30,000 up front, they may add a new wing as opposed to maintaining operations. I'm just trying to come up with, there's a lot of reasons why people delay contributions, but you do get the full benefit when you make the contribution to the donor advised fund.
All right, Chad's going to help walk us through some other notes and reminders around individual taxes.
Year end, it's always a good time to talk to your CPA about personal tax situation. I'd also throw in there with your financial advisor. I have a lot of phone calls with financial advisors these days, maintaining your capital losses. From our end, perhaps we look at some things with your qualified business income deduction, just to make sure that you're able to take the full benefit of it and you're not limited by anything. I think that might be a little too nuanced for we're getting into right now. Virtual currency, the IRS is, everybody that touches virtual currency these days just about has to report it. So the IRS knows if you have it. If you have anything, you have to let us know. There's specific tax forms that have to be filed. They already know about it. If there's any transactions with them, whether you're buying or selling with it, whether you're generating it through a Bitcoin mining operation, all of that's, it has to be reported. So, if you have income off of it, you have to pay tax on it. If you've got deductions from it, you can write those off. But more importantly, if you touch it at all, the IRS knows about it, and you have to, there's forms you have to file on that. So that needs to be brought up to your tax preparer whenever tax time comes around. That's something really easy to miss, and people get into it for just 1 year. If they didn't have it last year, we have no idea about that. The next one's just like that. The 1095-A, if you join the healthcare marketplace for your health insurance, the IRS knows that, and you need to bring us your 1095-A, which they're required to provide you. And that basically tells us how to treat it on your taxes. So, it could be a benefit or a detriment, depending on the situation, your situation. But it's going to generate a notice. It can reject e-files because of it. There's a lot of reasons. It limits our ability to present it in the most favorable light to the IRS as well. So if you are in the marketplace, you need to let your tax preparer make them aware of it.
Yep.
The Dirty Dozen. So the IRS was not annual. It's constantly updated. So they've got on their website their Dirty Dozen items of things to watch out for or things they're paying attention to. The substantial increase in IRS funding, that's not on the Dirty Dozen, but I do want to touch on that. So the IRS's funding has substantially increased for this year. They're hiring a lot of new people. That's in a lot of ways a really good thing that helps them process everything faster. It allows us to deal with them faster. They're not fun to deal with all the time. Hopefully, with some more talented people, we'll be able to move things faster. But it also probably means more scrutiny, just something to keep in the back of your head. We don't really know exactly what that looks like yet. That's kind of an internal thing for them. Fake charities, I think like it says on here, they usually follow natural disasters. Just be careful who you're giving money to. They may just be pocketing it. They may not be, substantially set up. Phishing and smishing. Basically, if somebody asks you for your information, be very wary about it. Passwords are important. Virusware is important. It's important to make sure that people aren't able to take advantage of you and your good credit and your good name. Something that is on the Dirty Dozen is conservation easements. So if you're involved in this, it is flagged to the IRS, and they do usually look at every individual case with this. And the main thing they're looking at here is overly aggressive valuations in the conservation easement that's set up. There's a lot of room for abuse there, and this is something they're paying attention to. And literally, they look at every tax return that's like this. Tax preparers seeking compensation based on refunds. We're in the business of accurately and favorably preparing your taxes to the IRS under regulations. This is anathema to us, but if somebody's looking to do this, they're probably putting you in a bad situation long term.
Sorry, delay.
No, that's fine. Fraud awareness and information security. I think the first thing to go to here is the IRS doesn't have an Instagram account. They won't call you. They don't send emails. They won't send me emails. I have to fax them everything or mail it to them. Anytime you hear any of this, the odds of it being fraud are 99.9%. If you're ever concerned about it, you can reach out to us and we'll tell you don't respond to it. Or you can reach out to the IRS directly and they'll tell you it's not. They primarily operate through paper or mail. So you'll receive a notice, and at that point, you would want to get in touch with us. That's real IRS communication. They're 30 years behind. Scammers and promoters of scheme. This is usually fly-by-night people. Look at the other emails that's nearby. It's people it's aggressive at best. It's fraudulent at worst. Generally speaking, feel free to point these out to us, but the majority of these people are not putting you in the best possible situation long term. Protect your information. There's lots of free services where you can check your credit. It's recommended you do that regularly so that you can see who has who's taking out loans in your Social Security number. That's a good thing to look at so that you can make sure that they're not taking advantage of you that way. The IP PIN, that's a fun one. So the IRS encourages you to apply through their website to get an IP PIN. And what that is a 6-digit number that changes every year. And it basically, the IRS needs to see that from you in order for them to accept your tax return once you've applied for it. So that keeps people from filing fraudulent tax returns in your name. I want to emphasize that if you do that, we need to know about it because they won't allow us to file your taxes for you if we don't include your IP PIN. Something else to consider is that it doesn't stay the same every year. They'll usually send you a letter with an updated one every year, and we need that from you for every year. And the IP PIN goes for both taxpayer and spouse. So if you're married filing joint, both Both people have to provide one. You can just have an IP pin for one of them, but you know, it's, if you both sign up for it, we'll need both IP pins.
Indeed. All right, I think that wraps up our individual portion of the presentation. Moving on to our business topics now. Some of the top updates for 2024 include just a reminder that the employee retention tax credit will be expiring. If you submitted one of those claims in the latter half of 2023, the IRS shut down processing of those claims. You have not heard from them, and you will not. They'll pick that back up in January, and I'm sure they have a nice stack to deal with now. Throughout the past probably 18 months, I've had clients reach out asking about the ERTC program. They've received, usually through faxes. Sometimes it's a call or an email. We call them pop-up credit companies. They're offering, big dollars to the company without ever seeing the financial statements or knowing if the company qualifies. There are qualification provisions. And unfortunately, those big dollars are very attractive. Just like Chad had mentioned before, one of the IRS Dirty Dozen were taxpayers seeking refunds based on, charging fees based on how much refund. These credit companies do the same thing. They get paid based on how much credit they are receiving for the company, and they don't always stay open to help defend you in the event of an overly aggressive approach to that application. So just be aware of that. If you have research and development expenses, you are none too familiar with this research expense capitalization that happened starting in tax year 22. We keeping our fingers crossed they'll be overturning that in the coming tax year or calendar year. It was a pretty big thorn for a lot of clients and taxpayers. It's just the requirement to add back and amortize over 60 months research expenses. And then we'll touch on this a little bit later, but there have been some changes to the bonus depreciation provisions. Going into business tax credits briefly, research and development credit is not new, but what is new at the end of 2022, the IRS has stated that they will be doing an automatic review of any business return claiming R&D credit, including requiring all documentation that supports the calculation of the credit. So if you're interested in pursuing the R&D credit, highly advise that you do it in the current year. Do not amend, because it'll probably be written down. It's a very popular, it's a subjective measure, and so the IRS will likely adjust it down. Work opportunity credits are something that are available to employers, employing members of certain target groups. So if that's something you think you might be eligible for, definitely look into that program. There are some applications and setup necessary to obtain the credit. And also, just like for individuals, there are energy credits. There are several business credits, but the more common or easily accessible credits are the clean energy vehicle credit. Each business can receive that up to $40,000 per year based on the number of vehicles that are purchased. I'll turn it over to Chad to touch on a few of the Georgia credits that we have.
So this is a fairly complicated thing. So we're going to kind of go over it from a broad perspective, and this is more to trigger your thoughts, or we're looking for opportunities for you here. So I'm going to kind of give you some circumstances where this is beneficial. The Georgia retaining tax credit is a very beneficial credit inside the state of Georgia. If you are in a high technology field, think engineer, at really any kind of technology field, or if you've instituted new software, those expenses work towards a Georgia retraining tax credit. There's outfits that come through and they'll calculate all this for you. It comes off of your it comes off of your income taxes that would be due towards the state of Georgia, dollar for dollar. I mean, if you've been sending people to conferences for software training, and it's worth asking us about this to see if this might be something that might work well for your organization and its owners. That's kind of the overview of that. But I mean, if you're in a high technology field, or if you've implemented new software, feel free to get with us on this. We would love to see if this would work for you. It's very beneficial for some people. The Georgia Jobs Credit, this is highly contingent on the county you're on. The state rates counties, and some counties get a much bigger benefit from this than others. Also, it says down here at the bottom, you must be creating at least 2 jobs. It's at least 2 jobs, but it's 2 jobs in some counties. In Chatham County, it's much higher than that, for example. But if you're a new business or if you're growing quickly, this is something we need to pay attention to because, again, this is very beneficial offset to Georgia income taxes that you have to pay. So if you're really growing, come talk to us about this. The Georgia Investment Credit. Now, this is for manufacturing companies and telecoms, essentially. If you're one of those, contact us because it's very beneficial. You basically get a credit for 1 to 8% of equipment. Again, it's depending on the county you're in, which is available online and it's available to us too. You got to do at least a minimum of $100,000. This again is a huge credit for certain companies. You're not in manufacturing or telecom, it doesn't relate to you.
Right. I'm going to switch it over to state tax considerations. There aren't too many here, though there are some that you'd want to consider as a business owner. The first is with COVID, and if you had employees move out of state and start working remote, you probably have already interacted with this, but remote employees can create state tax consequences and filings for the business. Some states have if you have just one positive factor and payroll is considered a quote factor, then that could potentially cause an income tax filing requirement, not just payroll taxes. We've mentioned it before, but this interplays with businesses pretty heavily, that $10,000 limitation on state taxes on the personal return. To skirt that, several states, especially Georgia, Tennessee, and several others in the Southeast, passed a law that allowed the business to pay state income tax at the company level. What that means is the company can then deduct the state taxes and reduce the business income that passes up to the owners. It effectively gives them the state tax deduction they were missing on their personal return. So that's been a great opportunity for several clients. And we talked about the depreciation changes in capital assets, and Chad's going to touch on that for us.
Just briefly on the pass-through entity tax.
Oh, sure.
The benefit to that is, whatever your highest federal marginal tax rate is, that's the benefit to you. So, if you're in the 37% tax bracket, any $1,000 deduction you can make at the corporate level instead of the individual, that's going to save you $3,700. Did I say 10,000 would save you $3,700 in taxes? Did I say that right?
You did. Yep.
Okay, just making sure.
Your math checks out.
Okay. Capital assets, section 179. If you purchase new assets, you can either take a bonus depreciation or section 179. Currently, strategy we use is to 179 assets because Georgia doesn't allow bonus depreciation. So if we take the section 179, we're able to take it both at the federal level and at the state level. So there's Georgia benefits to that. If you are in the business of adding a lot of assets in a year, if it's over $2 million of property, some of those benefits start going away. So that's when bonus depreciation becomes effectively beneficial. Starting this year, and it continues on next year. So this year, instead of 100% being able to write off business assets through bonus depreciation, it goes down to 80%. So that doubly makes it more beneficial to be in 179 instead of bonus. I'm just kind of making you aware that that's out there because this pretty much bonus depreciation goes away going forward under the current legislation. If we go back to the other one, just briefly, I wanted to mention a few things. If you buy trucks, automobiles, 179 can be limited. Bonus can be too, just depending on the assets. Did I miss anything on that, Emily?
I think you touched on the core elements of it.
Okay.
Let's move on to cost segregation since we touched on bonus already.
Well, just briefly on the last one, the 100% write-off for meals that involve a restaurant, which allowed us to 100% deduct most of meals for 2022. That will not be available for 2023. It goes back to the old 50%. That's just a one year thing. Well, I guess it's more than 1 year, but that's a COVID thing that's gone away.
Yep.
Capital assets. So this is something that we want to just plant in the back of your head. If you're a business or you've got a business purpose personally, if you spend over $500,000 on a piece of real estate, now it can't obviously be land. It needs to be either construction or you're buying a building. Business depreciation is over 39 years. So you would get a very small deduction over the next 39 years for the $500,000 you spent. If we do a cost segregation on it, we can pull out some of the smaller assets involved in the purchase, and we can deduct it over a much shorter span of time, which also gives us eligibility for bonus depreciation. So the idea behind this is you spend all this money. If you are able to cost segregate the costs apart for the different components of the real estate purchase, then you can take a big chunk of your depreciation in the first year. So the $500,000, in order for us or us to get somebody else involved, it needs to be a substantial enough property for it to make sense for it to work through. But this is a big thing that we're always worried we're missing, and which we feel like clients miss out on. Obviously, you get to depreciate a lot more, a lot faster. Most buildings aren't worth much after 39 years. It's just from a time value of money and from a income tax perspective, it's very beneficial to be able to do a cost segregation on big purchases. Changing gears completely here. If we're seeing a lot more clients that do a self-employed, self-insured health plan. They have to file the 1095s that we mentioned earlier that individuals receive and they have to use on their taxes. If you've got, so it says here 50 full-time equivalent employees, which equates to about 42 really full-time employees. So if you've got over 40 employees, you need to be looking for this. There's penalties involved if you don't file this I believe it's in January. If you're not sure if you have a filing requirement, again, we're just planting the seed in your head that if this is out there, this is something you may need to be responsible for.
Okay. Thank you, Chad. We're coming to a close here. We're approaching the end of our hour. So let's talk about IRS hot topics. So we don't always know exactly what the IRS is thinking and what they're pursuing, but they have openly come out and mentioned that they will be asking for or reviewing households with income exceeding $400,000. It doesn't mean that if you're in this boat that they're going to give you a call. It just means that they might be reviewing more returns in this particular category of income. Something they've also, I guess they feel a little burned about is that they haven't really pursued publicly traded partnerships very much in the past. They've audited less than 1% of those. They're very large. Probably not, too many of you on this call, though some of you may be invested in a publicly traded partnership. They will be pursuing audits of those organizations a little bit more often. Something just to point out, they are aware that they are slow to process your paper forms. So if you received a notice and we've sent a response and you receive another notice, it's because they haven't processed the response you sent earlier. Usually requires a call to place a hold on the account to give them the time they need to process that paper. Something we don't talk about enough, but please always keep it in mind, retain support for your deductions, retain support for the business purpose of those deductions. There have been some recent court cases where deductions have been thrown out because either the support wasn't there or the business purpose wasn't present. It just is a reminder that is in the unfortunate circumstance of being reviewed by the service. Keep that insurance kind of in your files. Just keep that support. We've mentioned it already, but it's worth mentioning again. Lots of ERTC scams are out there, just enticing people with big dollars. And then just like individuals, businesses need to look at security. Make sure you have a security plan, train employees, review your payments to vendors, make sure they're going to the correct vendor. And then just be aware that if you receive an email, someone's trying to change a bank account for a deposit, give them a call. I've had a couple situations where clients have received emails to change bank accounts, and turns out that somebody, a hacker had gotten into their system, pretended to be one of the employees, and redirected the bank account based on an email. So definitely just keep your radar up for those things. And just want to close with some due date reminders. We all know about April 15, but be aware that your business returns, if you're pass through for your partnerships and S corporations, those are March 15. And then also due April 15 are the C corporation returns. And if you have a foreign bank account, there's a filing for that as well, due with on the same individual date. April 15 also has a due date for estates and trust. But be aware that extension only takes you to September 30th, whereas the April 15th extension for everybody else, you get till October 15th. But with that concludes our presentation. We really appreciate your time today, and have a great weekend. If I can get to that slide. All right. Thank you so much.
Thank you, guys.